Silver came incredibly close today, just a few cents away from touching the long talked about $70 level. Whether it was 50 cents, 2 quarters, or a handful of dimes, that small gap was all that stood between silver and a historic psychological milestone. Markets were anything but calm, and today's action deserves a deeper look. In this video, we're breaking down what happened in the silver market, why prices surged so sharply, and what this could mean going forward. Today marked an extraordinary moment for silver. Prices surged to around $69.50, the highest nominal level silver has ever reached. When adjusted for inflation, silver is now only a few dollars away from its true all-time high. That alone makes today significant, but the broader precious metals complex also delivered strong performance. Gold pushed to near-record territory as well, trading close to $4,440 before slightly easing back. Even so, it remains within striking distance of its historic peak. At the time of recording, silver is hovering just under $69, reflecting a gain of roughly $1.75 on the day, a move of more than 2.5%. For a metal like silver, that is a powerful single-day surge. What makes this move even more impressive is the speed. Silver climbed rapidly from its intraday lows, accelerating higher as momentum built. This wasn't a slow grind upward, it was a decisive push, signaling strong conviction in the market. Silver wasn't alone in this rally. Platinum surged nearly 7%, pushing toward new highs. Palladium outed notable gains, and rhodium joined the rally as well. This wasn't isolated price action, it was a broad-based move across precious and industrial metals, suggesting a larger macro story unfolding beneath the surface. So what's driving this powerful rally? There are two primary forces behind today's move, and both are deeply rooted in global macroeconomic and geopolitical dynamics. The first driver is monetary policy expectations. Markets are increasingly pricing in the possibility of future interest rate cuts. When investors believe rates will come down, non-yielding assets like gold and silver tend to benefit. Lower rates reduce the opportunity cost of holding precious metals, making them more attractive relative to bonds and cash. Expectations for rate cuts in the coming years have strengthened, and that shift in outlook is clearly being reflected in metals prices. Even the perception of easier monetary conditions can be enough to push investors toward hard assets. The second major driver is geopolitics. Global tensions have once again taken center stage. Renewed uncertainty surrounding international conflicts, energy routes, and regional stability has reignited demand for safe haven assets. Whenever geopolitical risk intensifies, capital naturally seeks protection, and gold and silver have historically played that role. Recent developments involving energy shipments, sanctions enforcement, and heightened military readiness have added fuel to the fire. Even without direct conflict, the risk premium alone can drive markets higher. Investors don't wait for crises to fully unfold, they price in risk early. Interestingly, silver has slightly outperformed gold during this move, and that's not accidental. Silver is unique among precious metals because it sits at the intersection of two worlds. It is both a monetary metal and a critical industrial material. Roughly 60% of silver demand comes from industrial use, including electronics, solar panels, electric vehicles, medical equipment, and advanced manufacturing. As global investment in electrification and green energy accelerates, silver demand continues to grow. This gives silver a second tailwind beyond traditional safe haven buying. While gold primarily responds to monetary and geopolitical factors, silver benefits from those forces and from real-world industrial consumption. This dual role is becoming increasingly important. In times of fear, silver can rally alongside gold as investors seek safety. In times of economic expansion and infrastructure investment, silver attracts buyers for entirely different reasons. When both forces align, the result can be explosive price action, and that's exactly what we're witnessing now. Looking at the bigger picture, silver's performance this year has been nothing short of remarkable. Prices are up nearly 140% year-to-date, putting this on track to be the strongest annual gain since the late 1970s. That kind of move doesn't happen often, and it reflects deep structural changes in the market. In several countries, silver has already crossed historic price levels when measured in local currencies. In some regions, prices are approaching or exceeding the equivalent of $100 per ounce. These moves highlight just how powerful the current trend has become. What's especially notable is that this rally does not appear to be driven primarily by speculative futures positioning. Data shows that hedge funds and large traders are not excessively leveraged compared to historical averages. In other words, this isn't just paper trading pushing prices higher. Physical demand, tight supply, and real economic forces are playing a major role. Supply constraints are a critical part of the story. Silver markets have been running structural deficits for several years. Mining output has struggled to keep pace with demand, while above-ground inventories have been steadily drawn down. Unlike gold, which is largely hoarded and recycled, much of the silver used in industry is consumed and not easily recovered. This creates long-term pressure on supply. Industrial demand for silver is more resilient than many people realize. Many of its applications are essential rather than discretionary. Solar energy, electrical infrastructure, medical devices, and data technologies all require silver regardless of economic cycles. Some of these uses may even increase during periods of economic stress as governments invest in infrastructure and energy security. At the same time, trading activity in major hubs has spiked, reflecting renewed global interest and tighter availability. Expectations are growing that these supply constraints could persist well into next year and possibly beyond. That means volatility is likely to remain elevated. Silver has always been a volatile metal, and this environment only amplifies that characteristic. Prices can move sharply in both directions, often faster than investors expect. While the broader trend appears bullish, pullbacks and consolidations are normal part of any bull market. This raises the inevitable question, should investors be buying at these levels? There is no simple answer. Markets don't move in straight lines. While silver may continue higher, it's also possible that prices will correct or consolidate before making another push. At some point, momentum cools, profits are taken, and prices retrace. It is entirely possible that silver could fall back significantly from current levels. A move down to $40 per ounce, while painful in the short term, would still represent an extraordinary long-term victory if it establishes a higher structural floor. Even prices in the $50 or $60 range could become the new normal. The challenge is that no one knows in advance where that floor will be. Waiting for the perfect dip can mean missing the move entirely. Buying purely out of fear of missing out can lead to regret if prices pull back. This tension between opportunity and risk is what defines volatile markets. Fear is a powerful force. When prices rise quickly, investors feel pressure to act. When prices fall, fear intensifies in the opposite direction. This emotional cycle is what drives much of market volatility. Even experienced investors are not immune to it. The key is awareness. Understanding that volatility is part of the process helps prevent emotional decision-making. Silver's long-term fundamentals, supply constraints, industrial demand, monetary uncertainty, and geopolitical risk remain strong. Short-term price movements, however, can be unpredictable. The best approach for many investors is to focus on long-term strategy rather than short-term price noise. That means managing risk, avoiding overexposure, and making decisions based on fundamentals rather than headlines. We are clearly in a bull market for precious metals. Bull markets don't last forever, but they often go further and last longer than most people expect. What the eventual top looks like is impossible to predict, but the forces driving this market are real and powerful. As we move toward the coming years, volatility is likely to stay elevated. Interest rate policy, geopolitical developments, industrial demand, and supply constraints will all continue to shape the silver market. This creates both opportunity and risk, sometimes at the same time. Ultimately, silver's unique position as both a monetary and industrial metal gives it a role few other assets can match. That dual identity is becoming more important than ever in today's world. These are extraordinary times for the silver market, and today's price action is a clear reminder of how quickly conditions can change. Whether prices move higher from here or pause to consolidate, the broader story remains intact. Now the question turns to you. Do you believe this rally still has room to run, or do you think a correction is close? Are current prices an opportunity or a warning sign? Share your thoughts because in markets like these, perspective matters just as much as price.